Thanks, everyone. Welcome to session 3, which is titled IFI Lending in South Africa, Implications for Democracy, Debt, and Sovereignty. So this session leads on from session 2 and really brings IFIs, it brings it down to the local context. Okay. So there'll be two speakers, Kamal Ramburuth and Dick Forsland. The first speaker on the session is Kamal, who will be presenting on IFI behavior in South Africa based on the IEJ report titled IFI's COVID-19 Lending in South Africa, Context, Contentions, and Policy Implications. A little background on Kamal is that he was a part of the co-founders of the Rethinking Economics for Africa chapter at WITS when he was a student, and he was a member of the WITS SRC. He has previously worked as a consulting researcher at the Southern Center for Inequality Studies and the United Nations Conference for Trade and Development, and now he is a researcher at the IEJ. So, yeah, Kamal, you can go.
Thank you, Yasira, and thank you, everyone. So, the first couple of sessions today, I think, set the tone for a lot of the topics that I'm going to speak on. So I'll go through the slides quite quickly. But today we're really talking about international financial institutions, which includes the multilateral development banks, or sometimes we'll refer to them as MDBs, and the IMF, which is not really a multilateral development bank, but also has a mandate for ensuring that there's enough liquidity in the international financial system, right? I'm going to speak about both the MDBs, which include, for the South African context, the World Bank, African Development Bank, the New Development Bank, as well as the IMF. And we're going to just discuss how these institutions lent to South Africa during COVID-19 and use this as a kind of case study to unpack what are the qualitative ways in which these IFIs channel finance to South Africa, right? And I think that some of the lessons, as was discussed earlier, are definitely applied in how these institutions borrow to other countries around the world. So the reason that multilateral development banks and IFIs are kind of different from a normal bank, why they're different from Standard Bank or ABSA, is that they don't lend necessarily for profit. Their mandate is not to lend for profit. Their mandate is generally to lend for economic development, right? The thing is that what economic development means can be something different to the World Bank that it is to the New Development Bank, right? And how that realizes itself in where and how they finance is different, right? But the kind of mandate for development banks is to lend in counter-cyclical ways. So when there's an economic recession, they should provide the long-term capital to boost up the economy so that the recession doesn't last so long. It's to provide long-term capital for financing development projects like bridges, like hospitals, like infrastructure, right? And to promote kind of mission-orientated investment. So for example, if you take out your cell phone, most of the technology in your smartphone, like a GPS, touch screen, all of these things come from development banks in the US lending to the army to invest in like novel ventures, right? So development banks play a very important role in innovation and long-term infrastructure. And these banks kind of came out of a mission, right? And the first mission that development banks came out from was the World Bank and their lending in response to the fact that most of Europe and large parts of the world were destroyed. The infrastructure was destroyed by the Second World War, right? So the first institution of the World Bank is called the Bank for Reconstruction and Development. That's one of the World Bank institutions, because it's reconstructing, entire cities, countries that have been destroyed by war, to rebuild the economy so that it can serve, growth, etc., etc. So these banks go through 3 periods. After the World Bank is established, there's 3 periods of regional development banks that kind of happened historically, that we kind of group together in how their approach and mandate changed. The first period was this kind of period where we see, okay, the African Development Bank is now established in 1964, and a few other banks in Africa are established in the 1960s and 1970s, right? And the mandate of these banks was to kind of like try to encourage regional integration and to fix market misalignment of incentives, right? Then there's a second phase of regional development banks. And in the second phase, after this phase in the 1980s and 90s, there's new banks that come into play, but these banks here also adopted with those new banks something called that we a lot of us know as the Washington Consensus, right? Which is this kind of neoliberal agenda that the principles include things like fiscal discipline, which we were talking about earlier, austerity, change in the priorities of public spending, taking away subsidies, increase and spending on health and education, tax reform. Things like making sure that the exchange rate is flexible, making sure that there's open capital markets, making sure that there's trade liberalization, the privatization of public enterprises. So these are the things that we know as the Washington Consensus. And along with the World Bank and these regional development banks in the second period, there was this push for the Washington Consensus, for neoliberalism, privatize, marketize, liberalize, right? And then we enter in the most recent period. In the last 10 years, there's these new players of multilateral development banks that kind of step onto the stage. And these banks are the New Development Bank, which is sometimes known as the BRICS Bank. I'm sure a lot of us have heard about the BRICS Bank or the New Development Bank, and the Asian Infrastructure Investment Bank, right? The Asian Infrastructure Investment Bank is considered by many people to be kind of an extension of the financing for China's Belt and Road Initiative. It's very much China's the main shareholder. It's like how the World Bank is to the United States, the Asian Infrastructure Investment Bank is to China, right? That's one way that it's been framed. And then there's the New Development Bank. And the New Development Bank is slightly different because in the New Development Bank, all of the lending goes to developing countries and all of the capital comes from developing countries. So between China, Russia, Brazil, India, and South Africa, we all capitalize this bank with the same $4 billion US, and that money all goes back to the BRICS countries, right? And you might be wondering, okay, if we have this $4 billion, why are we putting it into a bank to put it back? And part of the reason for that is because multilateral development banks are able to find projects, and the multiplier on their lending is higher than the state just investing it straight, right? And part of this has to do with like technical capacity about identifying good projects and stuff like that. But there's usually a higher return on funding that comes from multilateral development banks than we often get from the private sector, right? Okay, and just to make the point that these banks are of a different kind of, I would argue, a different kind of philosophical approach around lending, in that they don't encourage, well, that at least the New Development Bank as of such hasn't been pushing a PPP agenda as of yet. In the future they might, and that's a concern, but really the main implementers of New Development Bank projects in South Africa have been SOEs, right? And this is quite different to a lot of the PPP approaches that come from the likes of the World Bank and IMF. And I say this because often, we get stuck in this paradigm of like, the World Bank is the main MDB and they lend in a certain way, and that's just how the world is, and that's something that we must accept, right? And the reason I'm contrasting these banks is because we shouldn't accept that. And we shouldn't accept that because the New Development Bank is doing something differently, right? They're not using conditionalities on their loans, right? There's no policy conditionality, and they're financing mostly state-owned enterprises, right? Whether they continue to do that in the future or not is beside the point. The point is that it is possible for multilateral development banks to push an agenda for the state to be the provider of the public good and to scale up financing for crises like the pandemic or for the green transition. So that's a general overview, and just to look at South Africa, right, over the last, between 2015 and 2019, we can see here that the lending from the New Development Bank far outweighs that from the World Bank and the African Development Bank, right? So there's been this huge proliferation of lending from the New Development Bank that has scaled up, right? And partly because the state has supported that scaling up. And this is just a kind of historical view since 2011 to 2022. And we can see, there's the big increase. These are the New Development Bank loans. A big increase from New Development Bank loans. 2020 is the year of the pandemic. A huge 4.3 billion US dollar loan from the IMF. The New Development Bank lent about 3 billion over this COVID period. And the World Bank lent two loans, one of 750 million US dollars, and another one of, I think it was at 500 and something million US dollars. So just to show that lending from international institutions is increasing in South Africa, and it's done so drastically, right? And this is one of the reasons we need to pay attention. So what we did, right, at IAJ in a report, which I hope to give you tomorrow if it gets back from the printers in time, inshallah, is to look at the lending from these banks to compare. Okay, we can't just say, okay, this bank gave us this much and that bank gave us this much, so the one who gave us more is better or whatever. There's a few variables that we have to look at, right? We have to look at, did the loan come in US dollars, foreign currency or not? As Dom was saying earlier, foreign currency loans are more risky. If your interest rate is 5% and your inflation shoots up, by, I don't know, 10, 20%, all of a sudden you've got a loan that costs, between 15 and 20% more than you expected to pay on it, right? And that's a huge risk because our fiscus isn't increasing by 15 to 20%, right? Our ability to pay isn't increasing by the same amount as the exchange rate volatility. And so, this is it's a huge risk. So we need to ask, is the loan coming in local currency or foreign currency? The only bank that came in local currency was the African Development Bank loan, right? The other loans came in dollars. There was one World Bank loan that came in euros, but it was by request that the Treasury asked for these loans to be in foreign currency partly. And one of the reasons for that is that when we spoke to them, when we interviewed them, is that there wasn't enough foreign currency to pay for imports, and there wasn't enough foreign currency to pay for VAT, right? So those are the main issues. And then just to look at what is the grace period on the loan. So the grace period is like, we'll give you a loan today, you can wait for the grace period years. So most of them are like 3 to 5 years, and then you can start paying us back 5 years from now, with the assumption that the government will have stabilized by then, the ability to collect resources will have stabilized enough to repay those loans in 5 years' time. Because, for example, right now we're in a crisis. So that's the other thing to look at. And then the term, how long is the loan lent for, right? And there's a huge variation. The NDB loans are 30 years, the 25 to 30 years, the World Bank loan is like 13 years, right? The longer you need to pay it off for, the more interest you'll pay, but the less pressure there'll be on you year to year on that loan, right? So those are just some of the variables to consider. And I think we've discussed the exchange rate thing already, so I'll just move on from that. What we just did is we estimated what are the actual interest rate that South Africa will have to pay. And what's interesting is the IMF loan is only 1%. The New Development Bank loan is about 6.5%, and the World Bank loan is about 5.5%. The loan that came in South African currency is 8%, the highest, right? So that would include the risks that they consider with that. So there's huge variability in these loans, right? And without a doubt, the biggest loan at the lowest interest rate is what we want, right? So whenever we're speaking about climate finance, we must always ask the JP, what is the interest rate that we're paying? What does concessional mean? Is 5% concessional enough? Really, we should be fighting for, if these loans are coming from foreign countries, we should really be fighting for interest rates as low as 1 or 2%, 3% maybe, just as they are in some of the European markets, and at very, very long terms, so that we can pay them over very long periods of time. I mean, think about the loans or the debt that is paid after wars, you know. Only like 20 years ago, Germany repaid their war debts to the Allies over like 100 years, right? We should be thinking about 100-year bonds for climate, right? We should be thinking about the very long term, so that developing countries have the ability to pay those loans off over long periods of time, right? The crisis is now in terms of climate, and the capital is needed now, but that doesn't mean that we wouldn't be able to pay off these loans as we develop, you know, over time. So that's just one thing to consider. This is just the model we used. If anyone's interested, please feel free to ask. And then just to say that the total interest rate we estimated on each of the loans is about 45 billion US dollars. That's supposed to be rand, sorry. My apologies. So we've spoken earlier about mobilizing resources, and I just kind of put the total amount of these loans into perspective, right? To say, okay, we took on these loans during COVID because we thought that we needed them, but did we really need them? And what are the other, how big were these IFI loans during the pandemic in relation to other lending that occurs in South Africa? So those loans of about 8.5 billion US dollars only makes up about 3.5% of all of South Africa's sovereign debt, right? So it's not a huge amount of all of our sovereign debt, right? And that's over a 3-4 year period. And then just to look at taxes, right, which is something we need to focus more on, is just in 2022 alone, that 8.5 billion US dollar loan, those loans, only makes up about 8.5% of all taxes that the South African Revenue Service is able to collect, right? And in a context where during the pandemic, you had mining companies making massive, massive windfall profits, we weren't looking at taxing that, right, or taxing wealth. Instead, we were turning to IFIs and these international lenders, right? And so I think whenever we're taking debt, we must always ask, how much is this debt in relation to other debts, and how much is this debt in relation to other ways of mobilizing resources in our economy, right? So I just want to speak about conditionalities very quickly, right? Because the World Bank roadmap, what Chiara was speaking about earlier, the World Bank is really putting forward their front foot to say, you know, we are reforming, but we're not convinced, right? And if you take a look at this cartoon, you know, the guy in the first cartoon is saying, I claim this land in the name of His Majesty. And the second one says, I structurally adjust this land in the name of economic growth. Right? And just to give you some context, the loan we took in South Africa from the World Bank is called the DPO loan, Development Policy Operation Loan. And this DPO loan has a history of coming from these structural adjustment loans. It's okay. It has a history of coming from these structural adjustment loans that in the 1980s, if we remember, in the 1980s, Africa was put under these structural adjustment loans, partly because there was a debt crisis, and the World Bank kind of made this exchange of, we'll provide you financing and capital, but in order to do that, you have to change certain policies in your that your government will put forward, and how you organize your economy, right? And this is kind of something that really, as I mentioned in the beginning, it's something that only comes out of the 1970s and 1980s. Before that, the World Bank was spending money on bridges and infrastructure, right? And then this Washington consensus neoliberal period comes, and all of a sudden they say, no, you know, we don't know that you're going to pay us back, so instead you just need to exchange the promise that you'll change your economic policies, and we think that if you change your economic policies, your economy will grow enough for you to pay us back, and we're still waiting. And it hasn't materialized. right? This promise. So a lot of the research we did, and a lot of the research other people have done just finds that conditionalities have been proven time and again to undermine policy space, which we should put a firm foot down as progressive movements to say that we should decide democratically on our economic policies, and our state, with whom we have the social contract, should be the one to decide autonomously on that, based on the democratic input from us, right, of what those policies should look like. So I did some research about, what has the conditionality during COVID-19 been like for the IMF and World Bank in other parts of the world. Chiara touched on this briefly, but for both Bretton Woods institutions, so both the IMF and World Bank, they both pushed for a post-pandemic return to fiscal consolidation, privatization, and liberalization reforms globally, without accounting for the impact of those policies on poverty, inequality, and human rights. So can I ask quickly, someone mentioned earlier the distinction between World Bank policies and their actions. I don't remember exactly who it was. But part of the distinction between their policies and their actions is that their actions are telling governments to spend less, to do less, to invest less, and let the private sector do this investing. And then they say, but you guys aren't like doing your human rights stuff.
And you're not growing.
You're not growing. Why aren't you growing? There's not enough of this. There's inequality, and we don't understand the inequality, and it's because, and there's all these reasons. But of course, you're going to have inequality. Of course, you're not going to be able to finance the realization of the right to water or housing if you're telling the same government that they must spend less, right? So this is part of this kind of disjuncture between what they're saying and what they're doing through their conditionalities, right? So there was a research report, and during COVID, only 8 out of 71 of the COVID-19 projects by the World Bank actually removed financial barriers to access to healthcare, right? They continue to rely on policy conditionality to influence national policies, and generally the World Bank's kind of prior actions, so this is their language, prior actions, it's the same as conditionalities, even though there's this kind of narrative that it's not, right? And the prior actions, encouraged debt restructuring of public utilities, granting concessions and licenses, adopting competition policies, reforming and promoting public-private partnerships. And then on the IMF side, the IMF initially supported fiscal, spending on pandemic-related things, but afterwards kind of supported this fiscal contraction, right? Or spending less. And I just want to make the point that, like, I know economists are the worst, right? And I know we say things like fiscal constriction and austerity, and these words are often like very far removed from a lot of people. But just like as an example, right? The IMF, so in Kenya, right, the IMF's program required the Kenyan government to increase taxes on food and cooking gas, right? So for Kenyans, the cost of food, like just eating, will have shot up, right? And this is in a country where 3 million Kenyans face acute hunger, right? And so these things aren't neutral. They're not politically neutral. They affect people's stomachs. They affect people's lives, right? So just to bring that back, bring all this talk about structural what and conditionalities and prior actions, it's making people hungry. It means people go to hospitals that are overcrowded, right? It means people don't get full access to education, right? And then they're blamed for being uneducated by the same world order and Western institutions, right? So then we go and we look at South Africa, right? So we went and we read the loan documents of the IMF and the World Bank loans to South Africa, and we're trying to compare them to what's happening internationally, right? I want to read this. The World Bank conditionality. So the IMF loan didn't come with conditionalities, like binding conditionalities contractually. But the World Bank loan did, okay? So the World Bank loan, they said, okay, South Africa, you want this money, we'll give you this money. You need it right now. We know you need it right now, but we'll give it to you in 2 years' time after the pandemic is over, as long as you do ABCD prior actions, right? So, there was this debate early on in the year or last year, the last 2 years, is this structural adjustment, are these policy conditionalities? And the government was arguing, no, these aren't policy conditionalities because we already agreed to these conditions in the NDB, in this document, that document. I mean, if you read the NDB, that thing is 300 pages and it says it'll do everything for everyone. And if you just go and pick the three, neo or four neoliberal kind of policy conditionalities, and you say this is your policies, I don't know. It smells like structural adjustment. It tastes like structural adjustment. It's, I don't care what you want to call it. You can call it prior actions, right? So the World Bank loan, right, had binding conditionality. It said no withdrawal shall be made of the single withdrawal tranche unless the bank is satisfied, A, with the program, prior actions, being carried out by the borrower, B, with the adequacy of the borrower's macroeconomic policy framework. So South Africa had to have an adequate macroeconomic policy framework, right, before they got the money, right?
Is this the $750 million loan?
Yes, and good point. Lebogang, who's sick from COSATU, who can't make it today.
What's sick from COSATU?
No. Lebogang is from COSATU, and she's sick. So Lebogang, who's the researcher from COSATU, we're talking the other day about this policy conditionality, right? And we were saying this is ridiculous because we're giving away our sovereignty, we're giving away our policy space for a small manana loan that's only like 800 million US dollars. Like, this is ridiculous. Like, at least if we're going to sell the country, it must be for enough money that makes sense, I mean, honestly. So it's really ridiculous that we had binding conditionality on a loan that wasn't a huge amount. Then on this thing of adequate macroeconomic framework, it's very much what Basani was speaking about earlier, about conservative fiscal, monetary, and industrial policy generally. And I just want to make an interesting point that we need to watch out for going forward. So these banks very much see themselves as being part of like a club or a network or a system, right? When you speak to bankers from these institutions, they're like, yeah, we're part of a system, and this bank during COVID could lend for this thing and we'll lend for that thing. And they meet up, right? They chill and they have a WhatsApp group where they discuss what they call a common policy framework, right? A common policy framework. And it's in their documents, which is something we should be grateful for in terms of their transparency between the IMF and the World Bank. They have become way more transparent. So we know that they sit around and they're on the same WhatsApp group, right? But they their macroeconomic policies between the African Development Bank, the World Bank, and the IMF were in some ways aligned, right? And they set up this common policy framework. And part of this common policy framework kept referring to the IMF's lending advice, right? And the IMF's lending advice was such good advice that it was also part of the World Bank's binding conditionality. So I don't know if it's still advice, if it's part of a binding conditionality. I think there's a question mark there. And it was so strong that the government did it, right? And the advice was to have fiscal consolidation once the pandemic subsides. It was to end the social relief of distress grant after COVID and limit tertiary education subsidies. For the four lists in the room, we must see some action on this. And they wanted cuts and containment of the public sector wage bill. And they wanted to limit the expenditure on state-owned enterprises. Okay.
All of that is happening.
All of that has happened. Correct. All of that has happened. So it's very strong advice, right? There's questions about conditionality that undermines sovereignty. There's questions around neocolonialism, right? and we must call it what it is. Green structural adjustment, it's all part of a same kind of mandate, a same kind of narrative, right? Now, just to speak about the conditionalities of the World Bank specifically, and I want to touch on the conditionality because this is the thing, is some of them, right, were related to the pandemic, right? So you could agree that, okay, if this bank is lending me money to spend it on a SRD grant, electronic vaccination data system, and ensuring direct payment of unemployment cash payments, then that makes sense. They're giving us this money to respond to COVID-19, which is a long-term developmental thing, because dealing with the crisis now will help our long-term development, right? I think a lot of us could buy into that. That makes sense, right? But then there's these conditionalities that are like T's and C's applied in the small print that no one reads, right? Where they take your cookies and, that kind of stuff. So they wanted us to also approve the Financial Sector Laws Amendment Bill, to approve the National Climate Change Bill and the submission to Parliament, to approve the updated kind of greenhouse gas emissions targets, and to open the electricity sector up to private players, right? And they just threw that last one in there just in case to make sure. So it's a mixed bag, right? Like a lot of us would agree with the first set around dealing with the pandemic, but the second set is like, this has nothing to do with the pandemic. This has to do with your agenda, right? And some of us might even agree with the agenda around like the financial sector laws or whatever, but it shouldn't be for the IMF to tell us that. I just want to mention that if there is congruency between our national treasury and the World Bank and IMF, and they take a loan that kind of binds their hands, one, I would consider it a bit cowardice, right? Like, just take the money, pay them back. Why do you need to have these policy conditionalities, right? And secondly, sometimes they use it, the treasury would use it to validate the policies or that they are undertaking, right? And then they'll go back, when shit hits the fan, and they'll be like, no, but we have this loan and we have to pay back this loan and the conditionalities are this. So we have to abide by this, right? And this is why it's so important that we focus on debt in the next kind of few years, is because if this lending goes up by the $98 billion that Basani was speaking about earlier, all of a sudden, it's 35-40% of all of our debt is owed to multilateral development banks or Western states, right? If I owe Yasira 5 rand, that's my problem. If I owe Yasira, 5 million rand, now it's her problem, right? And I make that point because the amount of debt that exists between institutions and organizations is a power relation, right? You just have to go to Argentina to find that out. You just have to go to Greece to find that out, right? And speak to the governments who were in power, whether Peronista or socialist at the time, or even liberal, and ask them and about, how the IMF exerts power. And it's direct. They just come there as like a government and they tell you what to do, right? It's really scary. So we need to be careful about the terms and conditions on the debt that comes in to our country. I'm not going to go too much into the fiscal consolidation and targeting. I think we're all aware of this, of these things and how they affect our people, right? But now I just want to go back a little bit to the new development bank, right? And just speak about their claims of originality. Because as I mentioned, it's different from the World Bank and IMF because both the borrowers and the lenders are developing countries. In the COVID lending, at least, and of all the lending I know, there's no policy conditionality. They try to respect what they call country systems, right? They say, here's the loan, pay us back. We saw that their lending was just like a percentage more than the World Bank loan. So it's kind of competitive in the multilateral development space, although we would want even lower interest rates. But these are the 3 kind of principles that they say, okay, we're original based on these things. The one is member equality. So South Africa, the South African state, which we are supposed to inform through our democratic institutions of parliament and the executive, etc., etc. So we, those of you who are or part of South Africa's democracy should be informing the new development bank's mandate, because we are 20% shareholders in this bank, right? And I'm saying we because we must take ownership of these state-owned institutions, right? The New Development Bank is a state-owned institution, and we should have a say in it. And I mentioned that particularly because, for example, when the New Development Bank had its next, 5-year strategy, we didn't comment on that strategy. That strategy went straight to Treasury, and Treasury commented on that strategy. And it wasn't the minister, it was a technocrat who's unelected, right? And so I say we and we and we because that needs to go to Parliament. The decision to take loans of however much needs to go to Parliament, especially if it's going to infringe on our debt sovereignty, and especially if it has policy conditionalities, right? The second kind of claim of originality of the New Development Bank is that they try to lend in local currency. So their aim is 30% local currency. They've achieved this in South Africa. 40% of the lending from the New Development Bank to South Africa is in local currency. And we've been speaking a lot about the risks of dollar debt. And I think that this is a really great step in the right direction in terms of debt sovereignty and reforming the multilateral and international financial architecture. And then the last one is on sustainable infrastructure. So structures that don't have unpolluting, don't undermine sustainable development, etc. Right? There's a big problem around this about what is green and what is not green, and it's been mentioned before. So we don't always know that sustainable is sustainable, and there's big questions around this, around the auditing of what is green. So along with that, not knowing what's green, there's also a problem with the fact that of respecting country systems, and it's this trade-off between respecting country systems and sovereignty, because if you respect the country system, who knows what green is in Russia, who's another 20% shareholder in this bank? Who knows? I wonder, you know what green is in China? You know what the green taxonomy is in China? Do they have a green taxonomy in China? So we also like this big shareholder of a bank that lends to other countries that might not be lending in what is we call sustainable or green either, right? So this is a big concern around taxonomies and stuff like that. The other concern is that the New Development Bank is trying to be quick. They're trying to be faster. Usually it takes 18 to 24 months to complete a project, the appraisals for projects with the World Bank and stuff. New Development Bank, they're trying to say we can do this in 6 months, 12 months. And part of the problem with being so quick is that you undermine processes of transparency, of democratic participation, etc., etc. Okay, I have to hurry up. I'm sorry. I haven't gotten through any of this, but please ask me the slides in the question time so that I can make it up. So policy. So there's a question around the gender elements of these banks lending, and I think that we did this gender analysis of the policies of the different banks, and we've got a big critique of this, and essentially there's one of the reasons why we say like these banks undermine gender equality is because these banks lent to South Africa's COVID response. Part of South Africa's COVID response was lending to the SRD grant, Special Relief of Distress grant. But in the first month, it was more than a year of the Special Relief of Distress grant. That money that came in excluded caregivers, right? So there's a policy that was clearly patriarchal, systematically excluded caregivers, most of whom were women, right? So in the first year of relief, people who are mothers were excluded, right? Which meant that the recipients of the Social Relief of Distress grant, 70% of them were men and 30% of them were women, right? And if these banks are lending to projects like this, they need to know that before they distribute the money, right? They need to take responsibility for that. And part of our critique is saying that these banks have horrible gender, or some of them are horrible, some of them are weak, some of them don't exist, gender policies that lead to these unequal outcomes, right? And just to say that we need to make them responsible for the unequal outcomes. They must face the mothers that didn't receive the Social Relief of Distress grant, right? So that's a quick point on that. And just to say as well, it is very difficult to track the flow of money because it is fungible, right? It comes into the state coffers and it went out as tax lending goes out to all of the different things. So it is difficult to track rand for rand all of the lending from these IFIs, right? This is a very, I'm sorry, let me finish up. This is a very quick thing of how the lending was distributed amongst different projects. We also kind of used human rights in our report as a normative framework of what debt and money and the economy should and shouldn't do. So the economy shouldn't undermine human rights, right? The economy should develop to expand freedoms, but as a core minimum, as a basis, it shouldn't undermine human rights, right? So this is one of the things. We also had large problems with transparency and accountability, which you can read in the report. But just to say very quickly, why does this matter? It matters because it has affected austerity in South Africa. It matters because it threatens to be dangerous for debt and power relations between citizens, states, international financial institutions. And ultimately, it matters because in the lending of IFIs to South Africa, there was an undermining of democracy, an undermining of national sovereignty, and an undermining of human rights, right? Democracy was undermined by a lack of transparency and accountability in IFI lending practices. Transparency is the crucial first step to ensuring that checks and balances are in place for accountability, to avoid the corruption and things like that that we saw. IFIs undermine democracy through policy conditionality because we should make the policies through our democratic decision-making processes, right? And if there's policy conditionality, that democratic process is completely undermined, right? And as I mentioned, a range of human rights, because ultimately that's what austerity does, is it undermines your right to water, healthcare, education, and all of those kind of things. What can we do about it? That's what we're all here to decide. And I'm looking forward to hearing what comrades have to say about, in our individual organizations, in our movements, what can we do to confront this? What can we do to kind of really confront the power structures of international financial institutions? Thank you very much for your time, comrades.